Hello to our viewers. I'm Jen Kohls of Richardson Capital Management, and I'm joined with Dan Brown, our Director of Investment Management. We're here to provide the economic and investment update for July 2025. July was the third consecutive month for positive gains in the market. Dan, what were some of the catalysts for this positive performance?
The primary reason was that investors received more clarity around trade and tariffs. So during the month, the U.S. signed a number of trade deals with some of our important trading partners like the European Union, Japan, and Vietnam. And as it relates to trade with China, there were talks again, but the progress there has sort of stalled. So what we learned is that there's going to be more talks at some point in the future. And it's very possible with the August 1st deadline for higher tariffs that some countries will be subjected to the higher tariffs. But we don't think it'll be meaningfully impact the economy because even if they do go into effect, we think they'll last for a short period of time. And it seems as though most countries want to come to some sort of compromise or trade deal with the US. And then secondly, what we learned in the month is that second quarter earnings season is off to a strong start. So here at the end of July, we're about halfway through second quarter earnings season, and we see a number of surprises, both with top line revenue growth and then bottom line earnings growth. And the beats are broad based. So nearly all 11 economic sectors are beating both for revenues and earnings. And we think one of the primary catalysts here is that investors were too cautious thinking back to April and the outcome and the impact of tariffs. And so far, it's not having a meaningful impact. And we also see stock buybacks being a positive catalyst, and we would expect that to continue for the remainder of the year. So, as in similar quarters, we see both revenues and earnings surprises, and we would expect that to continue for the second half of the year.
After a negative GDP reading in the first quarter, we saw a significant rebound in the second quarter. Dan, what did we learn from this?
Sure. So we saw second quarter GDP come in above expectations, about 3%. And what we learned is that the negative impact from the first quarter of companies advance ordering from their foreign suppliers to get ahead of the tariffs that was largely offset in the second quarter. So if we take net exports and average them out for the first quarter, second quarter, they were largely a wash. So we still think the economy is on track to record positive growth for the year, but just a little bit less than the prior couple of years. So one of the themes that we've been talking about fairly consistently the past year or so is this soft landing concept. So soft landing refers to a slowdown in economic growth from the pace of the past couple of years, but it's not recessionary where the overall economy dips into negative or recessionary territory for a period of time.
And how are we thinking about growth in the second half of the year?
So we still think growth is going to remain positive in the second half, kind of regardless of what happens with the impact of tariffs. And one of the reasons we think that is with the passage of President Trump's budget bill earlier in July, there were some things that were positive for growth. So first of all, on the growth front, we learned that there's going to be some fairly meaningful expensing of CapEx for businesses. So business spending on capital equipment, structures, et cetera. So we think companies will take advantage of that, and there will be a fairly strong rebound in construction spending. And then secondly, there's just clarity around taxes. So clarity is always good. Investors don't like uncertainty, and we do have some clarity around what tax rates are going to be in the future, and we think those will be positive for growth in the second half of the year.
The Fed had their meeting late in the month and chose to leave the Fed funds interest rate unchanged. The last time they cut interest rates was last December. Dan, when can we expect the Fed to continue cutting interest rates?
Yeah, so the Fed wants to see a couple more months of tame inflation data. So the Fed's been on hold since December, as you mentioned, because they're concerned about the impact of tariffs leading to a spike in inflation. So far, we haven't seen that. But again, the Fed's taking a very cautious approach to inflation and interest rates. And again, we think a couple more months of tame inflation data will be enough for the Fed to cut interest rates later in this year. So we think that a modest uptick in the unemployment rate, along with tame inflation data, could lead the Fed to cut interest rates 1 to 2 more times later this year in quarter point increments.
With all that in mind, what is our outlook for the financial markets?
Yeah, so our outlook is still constructive. So we've had a very strong rebound in the stock market off the April lows. So we think going forward, we'll still see advances, but just not at the pace of the past couple months. Reasons to remain optimistic is that we don't think that the tariffs will lead to a spike in inflation, which will then lead to the Fed cutting interest rates further sometime later this year. Lastly, we just think corporate earnings will continue to remain strong. So for the past number of quarters and years, we've seen corporate results surprise to the upside, and we think that'll continue into the second half of this year.
Thank you for sharing your insights, Dan. And thank you for watching. We appreciate your continued trust and support.